Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies.
All right. Welcome, everybody, to the Norris Group Real Estate Podcast. We have a special familiar guest, sort of. So today we have, as our guest is Craig Evans, CEO of not only the Norris Group, but today he's here as CEO of DBL Capital. Because there's some exciting things happening in the fund, and we just wanted to highlight it. Kind of, we were just throwing this around, and like, man, that was a really good meeting we had a couple weeks ago with the investors. We had a private dinner and some great conversations, and just some things even that I didn't know was happening. So it was really cool. But before we get into what the fund's doing, Craig, how you doing today?
Good, man. Very good. It's good to see you. You know, it's been very busy with my family and everything going on, but it is good to sit down and chat with you today.
All right. So now the first word out of your mouth is family. So actually DBL Capital and everything you do is framed around family. Tell me why that's so important to you.
Well, a lot of people don't really understand what the DBL stands for, and it's Douglas Brooke Legacy. And so Douglas is actually my middle name. Brooke is my wife's middle name. And legacy is all about the legacy we leave behind. We can make money, we can do a lot of things, but to me, the important thing is what legacy do we really leave in this world? And that's my big goal as we're working through and developing the companies that we do is how do we leave this world behind us? So that means a lot to me.
Now, one of the things is that, and a lot of people kind of, not that they hide it or they just, they wait until it's a comfortable setting, but not for you. Faith plays a big part of you in your personal life, and you don't shy away from it in business. So can you talk about that a little bit?
Yeah, Joe, we talked about this a little bit before the meeting out in California. I've actually had some friends that tell me, hey, you need to tone back your rhetoric and the talking about your faith, And I actually started to consider and think about that, and I just was ready to, I was disappointed in myself that I was even willing to consider that, and so at the last event, I as always, I'm unashamed about it. I'm gonna talk about what I believe. I mean, my faith means more to me than anything. I know the life that can be pushed on us. And the challenges that can come, and I know without my faith in Jesus Christ, I know I'm in a rough spot, and we talked about it a little bit that night. Everything I do really bases on or spins off of three priorities. I really try to focus on what's the priorities in life, and my number one priority is always and always will be my faith in Jesus Christ. How do I live my life? I don't beat people over the head with it, but I really work hard and try to live the life of saying, God, help me to be a better man tomorrow than I am today. How do I make better decisions and live a life that pleases God more than what I did yesterday? My second priority is always and always will be my wife, Stephanie. Again, Stephanie Brooke. She's the Brooke of Douglas Brooke, but my wife is always my second priority. I love my children, but my wife will always be my highest priority above my children. I chose her first and she chose me. But then my third priority is my children. I've got Georgia and Addison. You know them both well. And I love my girls. I'm so proud of seeing what they do. And Georgia's in college in North Carolina and working on her music degree. Addison has just graduated from high school and about to start at USF in her business degree, looking at finance. She's looking at coming on with us. So I'm super excited about my family. But, Joey, the thing that people talk to me about and ask me, like when I talk about these things, they say, well, you didn't talk about your business. My business isn't my legacy. The business isn't who I am. That doesn't determine who I am as a man and what I leave behind. Those are just tools that I believe God gives us to be a steward within this world. What I've been given stewardship over is my wife and my family, to be able to try to lead the best I can with all my faults and failures as an individual, to still try to be a leader that makes them proud and that makes other people proud of the legacy we're trying to leave.
Well, a lot of those qualities translate when you're talking about being the CEO of something. You're talking about being the fund manager and taking that stewardship, that core belief that you have in being a steward for other people and being of service, where you're you're like a dog on a bone, just protecting that equity, protecting people's money, and protecting their legacy that they're trying to build.
Well, and several people have asked me, what is my number one thing that I strive for in business? And every business has a different value as far as what are we trying to achieve. As a fund manager, obviously, I've got a goal of trying to deliver fantastic value to our investors, to deliver safety to our investors, protect their equity, all of those processes. As a builder, we've got to be a good operator and build timely and build quality product, all of those aspects. But at the end of the day, when I turn around and I look and I say, hey, really what makes us as a company, it's how well do we serve others, and for me as a CEO, I'm not the one building the house, right? I'm not the one doing all the things. So for me as a CEO, really I have to look at it in how do I serve those that choose to work for us and work with us? How do I serve them? And I believe that the more I can be a servant to other people, that helps in that aspect of me being able to provide that. And then as a company, we are better servants to others and produce better products.
One of the biggest talking points in the country right now is affordability and the crisis that we're going through as a country, and people just not being able to afford homes. You cite in your presentation that there's 21 million families that are spending more than half of their income on housing, and that there's a shortfall of 7 million homes in that price point of affordability and affordable homes. So walk us through why workforce housing is not just as the opportunity for you, but not just as an opportunity. It's like the one that you're going to focus on, and everything that DBL Capital is focusing on right now.
Well, to me, it's where do I place my values, and I think a lot of that goes back to my history. Joey, I've built I've been a part of building a lot of big structures and a lot of expensive buildings and expensive homes, and those are all, they're good egos they're fun to brag about, and the attaboy, you pat yourself on the back because wow, I did that. But at the end of the day, most of that's just a dollar sign to somebody else. Part of why we look at the affordable housing is, as a builder, when we get Christmas cards at Christmas time of people that have just been able to come out of an apartment and have their first Christmas in their own house, that's a big thing for us. We love when we get those. Do we get them every day? No, listen, I mean, we don't sit around and sing Kumbaya, and this is work, and people have lives to live, but the knowledge of knowing that we're providing a product that is so needed because of the affordable nature in our country right now. You mentioned it, and it's on some of our data and stuff. There's about 84 million families. Well, over 21 million of those are spending 50% of their revenue, their annual revenue. Over 50% of their revenue is going to pay for housing. It's no wonder that families are living week to week trying to figure out how to make it through, when 25% of the country is saying, hey, we're spending over half of what we make just to have a roof over our head. I think we can do better than that. I think we can be better than that. Now, it takes effort. It's hard work. to work the pricing like you have to do. It's hard work to beat the times and to operate on the schedules that we attempt to work off of. And it is a lot of work to do that. But I think there's great value in that. I think, you asked me, why did I choose this as a fund for our fund? There's a lot of Class A projects. There's a lot of high-end, luxury product that we could go build. And maybe we get a better yield if we hit right, But there's a couple things there. One is, if you look back through history, affordability and affordable housing has always been a seller. There's always a buyer that needs affordable housing. That's not going out of style anytime soon. Let's look at what's happened over 24 and 25. We've reached appreciation in this country and appreciation levels to where the markets just couldn't sustain that, even at middle price points and higher end price points. And we've had in some markets, 10, 12, or even more % of price damage, right? On some of those higher end stuff. When you look at where affordable housing is, we've had appreciation, but we really haven't lost back in that. So affordability typically sustains its pricing model. As long as the neighborhoods that you're building in and everything, as long as they're sustaining in their schools, as long as the crime model's not getting out of control and going crazy, it's a process that affordability is always a winner. So that's really why we look at it. We look at it from a dollar and cents perspective. It's always a winner. Two, it's a thing that is needed so badly in our country. And quite frankly, it's a lot more fun to see the smile on somebody's face when they know they've just gotten their first home.
So you call the infill construction messy and slow to scale. Why does that scare off the big players? But how does it actually work for you?
Yeah, I'm let's say I'm over 35 years of history in construction, and most of my residential experience has been all infill. And the difference between infill and community development and construction. Community development is a lot easier to build in. You can scale at that. Now, the timing on that can take play, or have an aspect of how you deal with that from a turn of capital. But because you can have a year and a half, 2 years of pre-development before you ever get to start breaking ground and going vertical, and starting to build vertical on the homes. So there's a cost factor there that you got to take into play. Obviously, as our fund continues to grow and the cash flow of the fund allows it, we will start to develop in communities as well. But from the aspect of if you really understand how to build infill, it is a niche that most institutional level funds don't look at, because it is exactly that. It's messy. You got to know what you're looking for. You got to know how to manage through entitlements. You got to know how to manage through permitting. And it takes an expertise and a knowledge that most companies just don't have. There's been a few that's been somewhat successful in it, but it is a harder process to manage. And so that's why a lot of builders really prefer going and building in a community, because it's just easier.
So most funds are going to go and try to acquire existing assets, existing companies, existing buildings, existing apartments. You're building from the ground up, and you're affecting the shortage by doing so. But why does that distinction matter with your returns?
Oh, well, the biggest aspect is, one, you're able to get a brand new product with virtually no capex needed for the next, let's call it 5 to 7 years, right? But the biggest aspect in doing that, we now get that at a truly wholesale rate. Most companies, when they're buying, they're just, Douglas Brook, our home builder, has been approached by several institutional funds to build. And in that aspect, what they are willing to pay is typically is a higher number than what we than what Douglas Brook or than what DBL pays Douglas Brook Homes. Now we do that specifically for a reason, and we've kind of geared ourselves to where, for the most part, Douglas Brook Homes, our home builder, only builds for DBL Capital now. We have a few investors that we build for on a private side, but for the most part, Douglas Brook Homes only builds for DBL Capital. So in that aspect, we're able to manage through those costs. We don't subsidize the costs. Douglas Brook Homes still has to stand on its own, but in managing through the numbers of that, we're able to deliver a lower cost product by staying streamlined and running lean. And again, knowing the markets, right? If we try to go into markets too quickly and don't understand the market, we've had scenarios where that didn't work well, and so that's some of the things that I've had to learn through life is, you've really got to understand your markets before you start trying to go horizontal and vertical in them.
One of the newest, and a lot of people don't know about this in your vertical stack, is couldn't kind of be your secret weapon, is DBL Home Mortgage. How does that create an advantage, when you're going to exit some of these affordable homes?
Yeah, so DBL Home Mortgage, we are super excited about that. That's been a great model for us. And in that, when we're able to offer rates that other people can't, before buy downs, anything like that, now we're able to come in and literally help people buy their houses. For instance, last Wednesday, we had a young man that was moving down from Jacksonville, needed a house, looking to buy a house. And, we said, well, listen, if you're going in and you use our mortgage company, DBL Home Mortgage, if you use our mortgage company, we can get you things that others can't. We're able to help you with some concessions, some closing costs, things like that. So we started working through, and what we started seeing was, he made plenty of money, on and on and on, but his debt to income was still affected because he had some debts out there that really he could affect pretty quickly just because he had some cash laying around. So not only were we able to, by far, beating every rate he was getting by over half a point. I mean, we were beating everybody's rates that he was seeing so far over half a point, which allowed us then to be able to say, okay, now we can work in and do more concessions for him, which helped him get into the house. And on top of that, our processors and our agents that are working on the loan closings were able to help him work through his debt scenario to clean up some of the debt that actually even got him down almost another full quarter of a point than what we'd originally quoted him. So having that in our pocket has been extremely beneficial at being able to get product moving and making sure that we can always provide the best product at the best price. And that's a lot of what we're trying to do. Because when we talk about affordability, the price may be good, but if the person can't afford the monthly payment, that's the problem.
So you've done over 100 million projects through multiple market cycles. Even you were a builder through Ian, and then you continued building after that. What has been the one thing over your career of building that has tested your model the most?
I would say, without a shadow of a doubt, those 2 years, back-to-back years of Ian, and then right after that, Helene and Milton. Those 2 years were some of the most trying years that I've ever seen as a builder. And especially because our headquarters is down in Southwest Florida. At that time, we were spread into 4 markets. We were in 2 states, and we got pounded in both states by both storms. It was a rough time to be a company the size that we are. Right, we're not a Lennar, we're not a D.R. Horton. So as a company that's for our size, which we were growing extremely fast, 2022 we were listed as the 10th fastest growing contractor in the entire country, and that's got its own ups and downs and challenges and everything. But with that growth, that happened right at the time that Ian hit, and then Helene and Milton hit the next year. And we went from we're one of the fastest growing contractors in the country to now nobody can get block. Nobody could get trusses. Nobody could get anything. Where we go from I'm getting trusses in 3 days to now I'm getting trusses in 12 to 14 months.
Well, that was coming on the heels of all the disruption from COVID.
All of that came through, there's a lot of sectors in the country where everything is stick built, where it's all wood frame, wood frame construction, and because of the windborne storms and things that we get down in Southwest Florida, most everything here is built out of concrete block, and it's the cells have steel in them and they're poured with cement, and it was down to so many things transpiring that we couldn't even get the fly ash for the plants to make concrete coming out of COVID. So that's one of the things that slowed it down. So obviously the costs were an animal at that point that everybody was dealing with. But in the process of our cycle times and budgeting that, we were a very fast builder pre-COVID, extremely fast. We went to, after COVID, we were 12 to 13 months, for us, that was just demoralizing. But we would also then turn around and look and say, okay, well, hey, we got national builders that are building in 21 months. So we were still delivering far below where other builders were delivering at the time. So while it was one of the most difficult times ever to build through, it was a time that I'm proud to say we built through, and it was the time that we survived through that. Joe, me and my dad we're like best friends. I love my father, and I never forget, I was taking my dad to lunch one day, and he just looked at me, he said, Greg, he said, I've been building since I was 18 years old. He's 82 this year. So at that time he would have been 78, 79. And he's literally looking at me, he says, if I had to go through anything like you guys are going through right now, he said, I'd have never been in this business. It was just insane. It was crazy. But I'm at the same time, Joey, I'm grateful, because when you go through hard times, you figure out who you are and you start knowing what you can achieve. And so as hard as those years were of going through those two storms, not just what it did physically to the people that work for us and their homes and your communities and seeing what people have to deal with, but how do you then keep a business flowing when you've got investors to respond to, when you've got developers to respond to, when you've got trade partners to respond to, and then when you've got the people that come in your office every day that are working for you and they're saying, hey, we want to produce all this, but I haven't had power in 3 weeks. Those were tough times to work through, but man, I'm glad that as we come through that, we know who we are.
Well, and that's one of the things that people don't understand. They see a Lennar and they're like, oh, well, they just handle everything from A to Z. So they think every builder's like that. You're talking about over 150, trade partners that you have to deal with to make all this magic happen, right? And as we were talking about this before, that could be a double-edged sword. Sometimes there's some trade partners that you got to be a little tough on, and then sometimes the trade partners that will absolutely lift you up, right?
Yeah, the 24 and 25, I would look at and say, while the times of, let's call it 2020 when COVID hit, up through about 23 when we're coming out of all the storms and the hurricanes and everything that happened, those were extremely hard times, right? But those were hard times just as people, and because you're trying to figure out how this is working in life, right? Because there were so many nuances that were new to the world, right? There was things that had never really happened before. Then all of a sudden you get into 24 and 25, and especially into 25, and let's face it, we're talking about the real estate market did things comparable to 2008. Now, not as bad, but we had price damages in some markets of the country, 12 and 14%. Those were price damages that nobody saw coming. 22 and 23, while it wasn't hot like it was in 21 and 22, the market was still somewhat climbing and just an easy, steady climb, if not plateauing a little bit. I don't think anyone saw what happened starting in 2024 when the uncertainty of the markets due to inflation. and it was happening so quickly. There was so many markets and so many sections of the market that just really didn't know how to read that. So in that process, you had a lot of trades, different skill sets that were just grabbing work wherever they could grab, and all of a sudden you're going from a trade that shows up for you every day to now all of a sudden they're telling you, hey, we'll be there when we can, but they've already started your job. So now they're the contractor of record and you're trying to work through that because you'd have longer to change a contractor of record than you would to work it out and work through it with them. But yet the one you'd worked it out with had already gone and grabbed 20 other jobs, and they were just starting them all to get them on the books. Now, the flip side of that is, so obviously we had some trades that were and that's a part of construction, but we had some trades during that time that could have been a detriment to us, to a lot of builders, it would have been a detriment to. But on the flip side of that, we have a lot of trades that looked at it and said, wait a minute, we're all in this together. Let's figure out how to work through these trying times, right? And a lot of them have come back with pricing, with better service models, with things that said, hey, we want to be a part of the success of these companies like Douglas Brook Homes and DBL Capital. They understand what we're trying to achieve. And quite frankly, they all know our model of what we're looking at as affordable housing. And that's why we have a lot of the trades that we have right now, is because they are passionate and love the fact of what we're building just like we are.
So let's talk about that a little bit, where things are in 2026. We've already talked about how 25 was really tough, but now you did build some homes, and it's interesting that some of them you sold and some of them you kept. And so how did that, how did you make that pivot on the fly, and how did that work out for the fund and the investors in the fund?
Yeah. So in that process, I will say this, but in answering that question, a lot of the reason, not a lot, the main reason that we ended 2025 and came into 26 like we did is because of the structure that we set up within the fund. So when you read our PPM and when you read our fund docs and you read our operating agreement, a lot of people look at it and it's 120 pages or so on a PPM, and
it's riveting. Riveting.
It's some of the best. I always tell people it's some of the best bathroom reading you'll ever have, but it's in that process. We spent a lot of time at developing how the fund will operate. And I was very intentional about that because there's a lot of companies that when they start their fund, that they're just running out and they just want to get it going as fast as possible. So they get their docs put together and they don't spend a lot of time at really looking at what is the docs going to do for how you operate. Because in a fund, everything is based on what do your fund docs say? We have to go off that, right? So in that process, setting up our structure, the way we've structured it, provides a lot of security and protection for the investors. But it also, it does that because it gives me as the fund manager a lot of options of how I can move through and protect people by, I can choose, I've got multiple exit strategies. I've got multiple hold strategies available to us because of the way we wrote the docs. I've got a lot of limitations put on me, so I can't just go off and do anything we want. So in that, it really allowed me and started saying, wait a minute, because of how our fund is set up, we can structure this to be available for 1031 exchanges. So in doing that, holding them and now selling a lot of these off that we've chosen to hold into the 1031 market has been a very valuable process for the fund. And it's providing a great source of doors, if you want to call it, for people that need to do 1031s. So it's giving them good cap rates. So in doing that, that's really, I base all of that all back to the structure of the fund and how we've set it up.
Well, and the one thing that people don't understand is that the way the fund docs are set up and the way you've set up, you were able to get some massive depreciation because, Everybody talks about the best way to do that is to cost segregate. Well, because you're a builder, you know exactly what to segregate. So can you talk a little bit about how you created some really good depreciation for them?
Yeah, and again, that's one of the things as you really dive in and look at our fund. Um, most funds, Joey, are most funds today are not evergreen funds like what we do. Evergreen funds they're harder to set up. They take longer to set up. It's a long term plan that you've got to really understand how all the pieces fit to make them work. The easier funds to do are syndications, which is typically a one-off deal. So in that, as we've talked earlier through the conversation here, typically in a syndication, you've got a few guys or a few people, men, women coming together, and they're going to buy a project. They're going to buy a multifamily building, or they're going to buy 10 houses, or whatever the deal is, right? Couple things. They're not a builder. So from an IRS perspective, they don't get to take cost segregations as a builder does. They actually have to pay to get those cost segregations done. As a builder, we know where those lie, and the builders are actually allowed to take and pass that through because of how our structure is integrated. So we're actually able to pass those segregations on for depreciation. But the depreciation, the segregation side is one thing of it. But again, in the depreciation of what we chose to hold, we chose to hold 6 projects last year that gave us a return that was, well, let me back into that. The return will be realized once the sales transactions are closed, but the asset value that remains inside the fund is over 100%. We're almost 100, and I think it's 117, 118%. Is what's in the fund from an asset value based on what we chose to hold. We sold some off. We chose to hold some that maintained an asset value growth inside the fund over 100%. And in doing that, by holding brand new properties, we're now able to create standard depreciation off of those, right? As well as cost segs that we passed on that, again, because we're the builder, we don't have to pay for cost segregations. We're able to pass that on directly through because we know what those are. So those are the values that the vertical integration that we've got, as well as the opportunities that we have to buy, hold, everything. Again, going back to the structure within the fund, that's what it allows us to do.
So let's talk about that fund structure and how investors actually make money. So can you talk about what the investment in the fund is and what the waterfall is?
Yeah. And now when you say the investment, you mean like the minimum investment or the structure? Okay. Yeah. So let me be clear. I mean, Joey, everything we do is in affordable housing. So it is a housing fund. We have it written to be able to do a few small things in case we need to turn capital, but those are short stop gaps that are there. The primary focus of the fund is all affordable housing. So in doing that, again, we build housing for yield. We buy and hold to create depreciation. And again, all of that, if you noticed, I haven't said anything at this point about appreciation. In my viewpoint, appreciation is always the icing on the cake. If we're investing solely for appreciation, I don't believe that's a good strategy. I think that's a highly speculative strategy that carries a lot of risk, unless you're buying at 40 or 50 cents on the dollar. But in the aspect of what we do, I believe that appreciation is and should always be just icing on the cake. I don't believe that's anything we should be trying to invest for. But simply out of creating a yield on the front side and then taking the excess gain of that, buying and holding to then also turn around and create additional cash flow, but also to create depreciation. I think that is the biggest tax strategy and wealth generation strategy that we've got inside our fund that most funds physically don't have, simply because they're set up as syndicates for the most part. Now, From an investment standpoint, how does that work? So our minimum investment is $250,000. It's a $100 million fund. We're set up as a Reg D, 506C fund, which means that we're only for accredited investors. I cannot allow non-accredited investors inside the fund. SEC would frown on that, and I would be in prison. I don't want to be Bernie Madoff, So in that, you've got to be an accredited investor, and the minimum investment is $250,000. The way the waterfalls, and basically for somebody that's just starting to look at passive investing inside a fund versus trying to partner with somebody and things like that, the way you get paid is through what's called the waterfall. And the waterfall breaks out like this. First and foremost, once profits are generated, the profits pay out to the investors first. I never, as the fund manager, we never receive a dime until the investors have gotten paid first. And so that's called the pref. That's a preferential treatment, or the preferential payout. So the preference, or the pref payment is 8% return on equity. After that, we get a fee. And again, all of these are net of fees, right? So in other words, any attorney's fees, any accounting fees, any state fees, federal fees, all the fees that the fund has to pay after the profit's made, the first payment is to the investment pool or to the investment fund of 8% return on equity. Then there's a 1.5% fee that is paid to the fund for managing those assets. Then next, it's called the target. And basically what it is, it's an 80-20 split up until, in other words, you've got the 8% return on equity, and then the 1.5% that we get for managing. And then it's an 80-20 split, 80% to the investors and 20% to the fund manager. Dollar for dollar until the fund, the investment pool, has reached 12%. So for that next 4%. So in essence, it takes about another 5 points of profit to reach that full target of 12%, right? There's going to be 4 points for the investment pool fund and 1 point for the fund investor. At that point of anything that the investment fund sold, the fund gets well, let me back up. Once you reach the target of 12 return on equity, most funds stop there. They say, hey, you reached your target. Congratulations, you hit your number, right? That's what we told you where our goal is, and that's where we stop. What I'm looking at is I believe that we can do better. And I want our investors to know that we view this as a joint relationship and almost as a partnership in the aspect of we're pulling back the curtain on how private equity really functions, because all the money is made after all the pref is paid. So what we do is after the target is paid, after the target is met, if there's anything left of anything that has been disposed of, any assets that were sold, at that point, we'd take another 1.5% fee of that. Because again, the fund manager, we have to make money to stay in business. Otherwise, we can't get it all done, right? But you can see the fund, the investors in the fund are always first. Once we reach the target, if there's anything left, we take a 1.5% disposition fee of anything that was sold, okay? From there, all the monies left over are split 50-50. So that's a sizable number when we're saying, hey, BlackRock, Blackstone, all of these large institutionals, once you hit your your target with them, you're done. We're basically saying, hey, we're going to take you all the way to the end, and you get to split in the windfalls of everything that's on the backside of that. Again, it's all net of fees. We've got to pay realtors. We've got to pay all the professionals that have to do the work inside that fund. But that's there's a lot of differences, not just in structure of how we operate, because as an evergreen, we can do so many things. We have tax advantages. But the fact that we're willing and we want to say, hey, we want our investors to have just as big a windfall as we do, that's the big deal for us.
You ought to call it the Bubba Gump target, because after that it's 50-50. That's so funny. Now, that's something different, and also that the fact that you don't get paid until they hit, the pref. That's different. Why was that important, and why did that matter for you?
Well, many funds, they're structured, especially in syndicates, they're structured that the operator is going to continue to get paid while the fund is in operation and while they're managing things, because for a lot of situations, that's the only way that person that's managing that syndicate or that operator, that's the only way they make a living. And I understand that. To me, that's not good business. If people have chosen to invest their money with DBL Capital, I believe they should get the first returns. Again, that goes back to my faith. When I look at that, the Bible talks to us about, the first fruits go out. That's what's always paid out, right? And I think that the investors that believe in what we're doing and choose to invest and see the benefit of what we're doing, I believe they should be paid first. And that has been important to me and always will be important to me in all of our funds.
Okay, that's going to do it for part one of our interview with Craig Evans, CEO of DBL Capital. For more information on how you can become an investor with DBL Capital, go to dblcapital.com, or you can click the link in the show bio.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com